Assalamu Alaikum everyone, welcome back to the channel. In today's video we are looking at how you can diversify your portfolio. There are 11 different sectors in the S&P 500, some which I have already invested in, some which I haven't. Some of these sectors basically do not have any Sharia compliant companies that meet the criteria that I'm looking for. So even though there might be Sharia compliant in the utilities sector, they do not meet the criteria that I'm looking for, or they are not the companies that I want to invest in. So what we're going to do today is we're going to look at the financials. When I first started investing, I didn't think there will be any companies in the financial sector that will be Sharia compliant. But lately, having done a little bit of research, I found out there's a few companies in this sector that we can invest in. So we're going to look at two companies from this sector today. A lot of these are banks and so on, but they also include some basically ETFs will include Visa and MasterCard, but majority of the ETFs will include Visa and MasterCard in this sector of the technology, because they're not really the tech companies. They develop those cards and the technology behind it. They don't have anything to do with the day-to-day of basically they deal with the usage of it rather than the actual transactions and whatever. Okay, so we're going to look at the financial sector today, two companies that are in this sector that we could potentially invest in, and I'll tell you at the end of the video whether I'm investing in these companies or not. Right, so like I said, is the financial sector. The first company we're going to look at is called SPG or SPGI or S&P Global. This company provides ratings, benchmark analytics, and data to the capital and commodity market worldwide. They do a lot of ratings, so they help other businesses. So they help, for example, basically when it comes to like Dow Jones, for example, they rate some of the companies. So even if the companies are publicly trading, they'll do the rating section, they will do credit ratings of the banks and so on. They deal with basically asset managers, debt users, and so on. So they are almost like a data company. So they analyze the data, they basically rate companies, they take their financials, and based on their financials, they will give them a different rating. Okay, they obviously help other companies as well. They take their data, they help them to identify trends and so on. Okay, and obviously insurance companies, commercial banks, corporations, professional service firms, all of these companies, basically different sectors of the financial sector, uses this company to kind of basically rate themselves and then tell the world that whether they're good company or not and so on. So that's just basically kind of summary. If you're really interested, they have got so much information. Their website is really good read, and a lot of the things that they do is actually when we doing research to find out about companies, they the company actually that rate these companies, and they tell us whether this company is basically overvalued, undervalued, and things like that. And as well as that, they obviously look at their basically financial details for the next whatever years, and they can help you understand some of that data as well. Obviously you have to have subscriptions and things like that, but I'm not going to do that. So let's go over some of the things I want to share with you today. So like we said, they are in the financials. Current price for SPG or S&P Global is $434 per share. Their PE is slightly high. We normally look for 20 or under, but their trailing PE is slightly high. Now, if you're not sure what trailing PE or forward PE means, have a look at the video that we posted last week. Hopefully that will help you. This company is basically has a market cap of $100 billion. They pay very small dividend. They have been growing their dividend about 15 or about 16% over the last 5 years. They've done this for over 47 years. And as you can see, the payout ratio. So the payout ratio is basically how much of their income or the net income they spend on giving out as a dividend. Okay, and normally anything below 61% is very good, but 23% is even better. Their dividend safety, according to this website, okay, is actually 99%. So that means they've got a lot of money to basically cover the dividend. So they're not going to cut their dividend anytime soon. They currently have free cash flow of $3.5 billion. Soon I'm going to release a video on why free cash flow is important, but it's basically a month of money the company has to pay debt, to pay off dividend, to buy new companies and all that. So they've got $3.5 billion, which is plenty. Now the 52-week range is basically how low the stock went down and how high basically. Okay, so the lowest it's been is $303 and the highest has been $429. So right now, if you look at it today when the market closed, is $434. So it's slightly lower than where, slightly higher than where basically the highest has been. So this probably needs to be updated. The beta here is basically tells us how volatile this stock is. Okay, so anything below 1 is good. Anything above 1, then that means it's slightly more volatile, the actual market. Okay, profit margin of 31%. Normally we're looking for 15. You might decide 20 is the cutoff for you, but 15 is a good one. But anything above 15 is perfect. So 31, and then return on equity of 75%. We're looking for 15. This is 75%. Okay. Currently, so return on equity, by the way, is the how you give a lot of money to this company. What do they do with it? How much, what they do with it, and obviously how efficient they use that money. That's what it is, return on equity. Overvalued, undervalued at the moment, according to Simply Wall Street, is undervalued. Okay, and the stock should be about $674. In fact, that seems a bit strange. So let me double check that, because SPGI, because that is, I did the research, yeah, 686 in fact is not, I haven't updated that today, so about $607 to $680 per share. That's what they're saying it should be. So it's undervalued according to Simply Wall Street. Is actually undervalued about 36.5%. According to Morningstar, the stock is 2 stars, which means it's slightly overvalued. It's getting to that very overvalued basically range, and it should be the target. They're saying it should be the fair value for this stock should be 378. Okay, so that's why they think it's overvalued at the moment. So it's one of those situations. You've got two basically evaluations here. You can go in right in the middle and then look at your own, have your own margin of safety. Okay, so if you don't know what that means, have a look at the video that I posted about the watch list. Just have a look at that. So you need a margin of safety, so just in case anything happens, you kind of basically are on the safe side, if you like. And according to Yahoo Finance, it's a buy. So one other thing I want to show you is this is the Yahoo Finance. If you click on analysis and you scroll down here, the first thing you will see is earnings estimate. So this is earnings per share. Okay, so this is basically their total earnings. So they're expecting to basically this year to be about 11 and 11.7, and next year that's basically expected to grow. So which is good. So basically earnings are growing, and if we look down here, okay, so growth estimate for the company for the basically next 5 years is double digit, which is perfect. So double digit is, in my my opinion, I think that's a very good decent return on your equity. Okay, so again, this is SPGI. So if you look at the Yahoo Finance, you will see that it's almost like a strong buy at the moment, and they are saying the average is 448, currently 434 or wherever it is at the moment. So yeah, it's one of those companies that are not many people speak about because it's not as exciting as the rest of the companies out there. Those YouTubers that talk about all these crazy companies, but you've got company here that financially stable, great company to own. They do pay small dividend. At the moment, it feels like it's kind of fair valued, but obviously you will have to do your own research. Okay, but if you're interested, that's the first company we're going to look at. The second company we're going to look at is Moodys. Moodys is leading provider of credit rating on fixed income securities. They do similar sort of thing. So they actually help other companies in terms of they rate those companies. They do a lot of research and development. They work with a lot of companies basically to understand like the credit research and all that stuff, quantitative credit scores, economic research, business intelligence. And I think this is one of the companies that were kind of involved in the 2008 crash. I've heard stories about where this company was rating some of the banks highly, and the banks were not actually financially stable. So since then, I think they kind of got their act together, and they're actually now doing better than they were at the time, obviously. And again, it's not in the consumer discretionary. I should have changed that. That should say to financials. Then in here, yeah, that's better. I've kind of changed it, post the video, changed it. So current price of $379 as of today. P ratio of 34, so less cheaper than the other one if you look at it from that perspective. Market cap of $70 billion. The other one was over 100, so it's slightly big. The other one is a bigger company. Small dividend as well, again 0.66. 5-year growth of 10%, about 11%, which is really good. And they have done this for about 19 years, which is really good. Again, payout very, very low. 83% dividend safety. Again, $2 billion in free cash flow. And the lowest it's been, the stock price has been, was $253 per share, up to $384 per share. Beta is slightly volatile, so slightly above 1. Profit margin of 26%. And then you've got return on equity of 115%. Now, overvalued at the moment, according to Simply Wall Street, as well as the Morningstar. So this one, they expected the price to be 353. At the moment is 370. So not much, to be honest with you. And it's probably, if it drops a little bit in the next couple of days, maybe about 6%, 5%, whatever. I'm not sure if they release their earnings yet, but if they do and they drop, then it might be a good time to start a position. It's a buy at the moment. Morningstar says it should be $327 per share against $379 per share. So there you have it. There's two different companies, both in the financial sector. On top of that, you also have the Visa and MasterCard that kind of classified as a financials. But these two companies, SPGI, okay, or S&P Global, and then Moodys, are both great companies. They are, I'll be honest with you, is the kind of companies I would love to invest in. I'm not sure at the moment if I would start a position soon, but I think out of the two, I actually do prefer Moodys because I think it's got a lot more upside to it. Based on the research that I've done so far. I haven't finished it, so once I get more information. So what I normally tend to do is once I've done this kind of analysis, I'll go to the investor section and read about all the documents over the last few years, have a look at any press release, any financial statements, earnings presentations, listen to the calls, the webcasts and so on, and then do the same for both companies. And once I'm happy with everything that I've seen and the financials, everything looks stable. So like I'll look at these kind of websites and look at the ratios, key ratios. Okay, once I'm happy with this, then then I'll start maybe a position. If I think it's overvalued, sometimes I'll buy, like, I don't know, fractional shares, £5, £10 here, then nibble it as much as I can to build a position. I hope you enjoyed that video. If you like this kind of videos, please like, subscribe, let me know if you have any questions. I will be doing another one for materials, and I think I can't remember which one yet. Consumer discretionary. Those two I think I've got left. Energy, I'm not touching that yet until, I don't think energy I will be doing one for that one. Communication is quite a hard one as well, because there's not a lot of companies out there that are Sharia compliant. And if they are, they're not really the type of companies I would want to invest maybe yet. Maybe I'll do a little bit more research. Inshallah, I'll find a bit more information. But if you like this kind of content, please like and subscribe. Let me know if you have any questions. Take care. Assalamu Alaikum.